Journey with me into the land of economic theory. We're talking about the neutral rate, which is this theoretical rate of interest where it's economic nirvana. Demand for savings and investment is in balance, full employment, inflation is steady, everything is going steadily as she goes. Every quarter, the members of the Federal Open Market Committee, that's the policy-making body of the Federal Reserve, they put out this document called the Summary of Economic Projections. And in that, there's one of the estimates, which is their longer run estimate of what the Fed funds rate will be. And that's seen as more or less a proxy for what the Fed officials think the neutral rate will be. The median in September was 2.9%, but there was a pretty wide range. So Fed officials themselves can't agree on what the neutral rate is. There are all kinds of reasons to believe that the neutral rate for the US economy is a good deal higher today than it was before the COVID-19 pandemic. Some of those are good things, some of those are less good things. One of the good things is that productivity growth, that's how much output per worker there is in the economy, that's been growing at a pretty steady clip. And that's a good thing for the economy. That means that the economy can grow faster, and that raises that neutral rate of interest where everything is at break even. On the other side of the ledger, there's this persistent government deficit. That means more borrowing by the government, it's more spending on investment in certain things, but a lot of that also goes to non-productive spending, stuff like Medicare, Social Security. And as that government debt load continues to go up, bond yields should rise. That raises that, again, that break-even neutral rate for the economy. And that's less of a good thing. Some people think this is a conversation not even worth having. It certainly doesn't matter for the Fed's interest rate decision in November or December. Right now, interest rates are around 5%, and we're talking about a neutral rate somewhere in the ballpark of 3%. So we're way above that. But as we get to the point, maybe a year from now, maybe in early 2026, where we are kind of in that ballpark of what Fed officials think neutral is, this will become a much more lively debate, and that's barring any kind of recession or unforeseen shock, which totally derails plans. This is if we are in this soft landing kind of scenario that people like talking about, where the Fed can just glide to neutral and everything goes along hunky-dory.